Hey everyone, welcome to the second ever episode of Punch Card Investing. For those of you who missed last week's episode, we're trying to do this weekly sort of live stream conversation about value investing. And in the first half of every episode, we'll have a predetermined topic that one of us will pick and we'll have a conversation about that. And then for the latter half or so, we'll open it up for questions. And if you guys want to get involved in the conversation, we can do that and just talk about all things value investing. And before I move on any further, be sure to subscribe if you haven't already, because that would help us out a lot. And check out the Discord as well, so you guys can get involved there. It's a free Discord. Feel free to join that. The link is in the description. We'd be happy to see you over there as well. But for this episode, last time we talked about our best current investment ideas. This time we want to talk about our favorite investors, who often are a source of investment ideas and inspiration and different philosophies to go off of. And this one was brought to us by our very own Investing with Frank, so I'll let him start out with it. And who is your favorite investor, Frank?
All right, I'll just open it with saying that I don't think any of us are going to cover Warren Buffett or Charlie Munger. I'm not sure, maybe Tom will, he did touch on it. But I'm going with Chuck Akray today. So Chuck Akray he's a long-term investor with a pretty concentrated portfolio. I'll jump into his portfolio shortly. But he looks for what he calls compounding machines. So I actually just put a video on my YouTube channel this morning as well, talking about these compounding machines. He's looking for three things in the businesses. So a quality business, which is pretty hard to define what he calls a quality business. But from what I've heard, he's looking for like high returns on equity, sustainable competitive advantages, and a few other things. But I'm sure you can hear him talk about that. Then he wants, the second thing is quality management team, which I guess is one of my main priorities when I'm investing as well. The one quote I like that he said about management is he wants a management team that treats the shareholders like owners, which I found pretty cool. And then the last thing he wants is a business that can reinvest continuously into the future. So high returns on invested capital that can be sustainable for the long term, which I guess ties in with a competitive advantage as well. I'll just jump into his portfolio, so I'll read some of his biggest positions out. Fairly concentrated into MasterCard, which is his biggest position, and that's 13% of the portfolio. He also owns Visa, which is about 8% of the portfolio. So that's just over 20% into payments companies, which I found pretty cool. His second biggest position is Moody's Corp, which I don't know too much about. I'm not sure if any of you guys do. And he also has American Tower Corp at 10% as well. They're his biggest positions. Then he has a lot of other smaller positions at about 4 and 5% of the portfolio. But half the portfolio is in those four positions. But yeah, that's Chuck Akray, and that's probably my favorite investor at the moment.
Cool. What's Chuck Akray's background and performance track record like? Do you know, Frank?
Yeah, so I know since 2009, I think, or 2008 or 9, he ran the fund, and it's about an 18% return. So S&P 500 over that time period is around 13 or 14%. So he's outperformed the market since running the fund. And I just read this morning, I was just looking up some more things about him, and I think he might have just left the fund late last year. So I'm not sure if he'll continue running Akray Focus Fund. But yeah, so far the track record is majority his, and it's about 17-18%.
Yeah, cool.
I'll jump in. So I think 4 or 5 years ago, I saw a talk from Monish, and he was referring to Moody's as one of these companies that, a great business that an idiot can run. So, had nothing but awesome things to say about Moody's. I also noticed, and this is kind of under the radar, but Chuck Akray initiated a position recently in Topicus. I don't know if,
it's Constellation not. Yeah.
He also owns Constellation, right? So that might have been from the spin rather than him just buying shares in the open market. Yeah.
Interesting. I feel like Monish Prabrai actually said almost the same thing about American Tower that you just said about Moody's, Brad. So
is that right?
there might be a couple of sort of no-brainer, anyone can run type companies in there.
Bit of a theme there.
Does anyone know what Moody's actually does? I haven't really looked into it too much.
They're a
credit
rating industry.
credit rating agency.
Okay.
Yep.
Because
Yeah.
I heard him talking about it with one of his partners, a younger guy who I'm assuming is going to be taking over the fund now if he did step down. But originally Chuck didn't want anything to do with Moody's after the 08 crash.
Yeah.
Yeah. And he wanted nothing to do with it. He thought management were dodgy because they were providing some of those loans out, I guess. But then after, I think in 2010 is when they entered it, he went and sat in on an interview with management team and invested that afternoon. So once you meet him face to face, which is one thing I guess we can never do, but
It sounds like he got sold. Almost.
possibly. But I think it's been a pretty good return over that time period. I'm not sure what exactly it's been. I'll have a
Yeah,
look.
interesting. Just one other thing on Moody's. I think it was Guy Spear, who is not the person I'm talking about today, but just since we're talking about it, I think Guy Spear really likes the Moody's business and may even be a small shareholder. And he basically came up with this sort of mental model. I don't know if he came up with it, but he certainly implemented it of let's identify basically the Moody's business, but in other sort of parts of the world. And I think that's what led to his Crystal investment.
Yep.
So Crystal was like a huge home run multi-bagger that he sold after it had done that already for him, and it's gone on to do that like again and again and again. And it would be some huge proportion of his fund if he'd kept holding it. But I think that's an interesting sort of philosophy that I picked up. That's just something that came to mind when you mentioned Moody's.
You know,
Yeah,
there's
I just
another
looked
Indian
too.
investor. Sorry.
Moody's compounded over the past 10 years at 23%. So
Nice.
definitely a good position to be in.
Is that all?
So there's another Indian investor who got into Crystal at the same time as Guy Spear, and he's still holding it. So his name is Rakesh Jhunjhunwala.
You
Yeah.
did a video on him, didn't you, Karan?
No, not yet.
Okay. Some.
Yeah, do you want to throw up Crystal stock chart, Jack, just so the people know what we're talking about? Because that's been an insane return. It's CRISIL is the spelling, I think.
Yeah.
That's
Try to
pretty
get it over
simple.
like 20 years or something. I think Spear bought in like 2003 or something.
Yeah,
2002,
And so-
2003 around there.
2002.
yeah. Sold after like a triple or something, right? And it's,
Yep,
I
yep.
guess we'll see in a sec what it's actually done. But
It would have
one
been
of his
bigger than
biggest
his entire
mistakes.
fund, I think.
Yeah, his entire
he held
fund.
it.
Yeah.
So
Yeah, there you go. So Guy Spear might have gone like 2003 to, I'm just
We'll go
guessing a
there.
bit here, but 2003 to
So,
2007
yeah.
he probably got or something.
it's a nice little 5,000
that.
something % ish. That's
Yeah,
all.
that'd be nice.
It's a
It
good
is over
return.
20 years though. It's kind of a while, but still, that's pretty phenomenal.
That's crazy.
Jack,
Yeah,
would you not
unreal.
take that over 20 years? Would you say no to that?
No. Oh, absolutely.
20 years is far too long.
No, yeah. I need 1,000% next week. There's plenty of those recommendations all over the internet.
Yeah, give us Gamestop 2.0, Karan.
Yeah, Karan's
wish
the
I could
wizard
find
here.
it.
Yeah, you tell me, Karan. Karan, who's your favorite investor?
So the investor I want to talk about was someone who we actually all follow. So the founder of Value Investors Club, and he's also been very gracious in sharing his Magic Formula investing formula website. And what else? Yeah, so he thinks you can be a stock market genius, which is great. Yeah, so I'm talking about Joel Greenblatt here. And I'm pretty sure everyone is already familiar with him and his track record. Yeah?
Yep.
Yep.
Yeah, so he started in, I think, his fund around 85, was it? I think.
Something like
And then
that.
he closed in
Sounds right.
94. Yeah. He was compounding at like 50% per year before fees. So eventually the fund got too large and he's like, I just have to close this down and I'm done with it. So I think that's a good problem to have. And
For sure.
yeah, one of my favorite things about him is that he actually has a heart of a teacher. So through his books, I mean, I feel like he's helped out so many retail investors, and I think that's what I admire most about him. Yeah,
Well, he was a teacher too, right?
yeah. As like at times he would teach at Columbia.
Yeah.
He was
Yeah,
an adjunct professor. Yeah.
he is really good at distilling investing ideas down into pretty easier to follow sort of lessons. Like Magic Formula investing is very easy to understand. and it's kind of a good sort of intro into value investing among his other work as well.
He's very versatile as an investor also. I mean, he uses options, special situations, all sorts of things. But the underlying philosophy is always based in value investing, right? You know, buy something below its intrinsic value, sell at or around intrinsic value.
Yeah. So he sort of had kind of like two phases in his career, right? He was the you can be a stock market genius too type investor, which is more special situations, options. Often he was interested in the less sexy side of a spin-off, for example. He'd be looking at the company that's left with all this debt and no one wants to know about, but he'd be reading the filings and actually finding some of the stuff kind of interesting. And then he's kind of transitioned to more of a quantitative type investment approach, right?
I mean, I don't think he prefers to be called a quant per se, but yeah, I mean, it was driven by some quantitative approaches, but at the end of the day, I mean, he was just basically going long the stocks that he felt were undervalued and going short the stocks that he thought were overvalued.
He's definitely gone to a lot more diversified type portfolio than his earlier days, and I don't know if that reflects the returns. I don't know how his returns have been post writing those books really, but I think roughly his strategy these days is he has about 300 positions, most of them being long, like Karan just said, and then a few short positions overlaying most of that as a bit of a hedge too.
It looks like he's just trying to get like a slight sort of delta to the broader market returns, but is still relying heavily on just typical market returns, which is probably more defensive, which, every strategy is going to be a little bit different. And I guess as your portfolio grows, it'll tend to get more defensive, I would imagine, just because it's harder to find those like deep value plays at scale. So many. Go ahead.
I think most investors do that. Like the larger their fund becomes, the more money they have, the more safe they have to play it. And usually that turns into diversification. Buffett probably is the only person that didn't diversify when he got a lot bigger. So
it's still pretty diversified though, like broadly speaking, but yeah, not to the level of like a Dalio or something where it's just
and his big positions are concentrated. He has a lot of positions, but most of it's in Apple. So
that's true.
Yeah,
it's top heavy for sure.
Yeah, it's interesting. Li Lu obviously is managing quite a large amount of money. I think it's like 13 or 14 billion. And from what I can tell, I mean, we can only see his U.S. holdings, but I don't think he's gone that route of massive diversification. He's still pretty concentrated. Again, we can't see his whole portfolio, but that's my impression.
I think he only has about 5 or 6 positions that we know about.
13F wise, yeah.
I think he also has.
Facebook?
He is. He cut his Facebook position in the fourth quarter. Yeah.
Just trying to look it up on Ticker now to see what I can find, if there's any foreign positions on there or not.
And he recently added Apple, right? And then, which was a little strange, all things considered.
Pinduoduo, yeah.
Right.
He's been going into larger tech, yeah.
Yep.
I still don't know how I feel about Apple. Like, obviously it's a great business, but just as like a longer term compounder, because it's already just so humongous. You always wonder, like, when's it going to slow down more, or what's going on? Like, is this price worth it, even with a business as strong as Apple's? That's why that Li Lu move just seems so out of the ordinary for someone like him who considers himself a deep value type investor.
Yep. He does have a huge BYD position as well. I'm pretty sure that's his largest position, BYD.
Yeah.
He introduced Buffett and Munger to BYD,
right?
I think. Yeah.
Yep.
Yeah, and it's grown to be enough. You probably saw me drop off there. I didn't catch all of that discussion, but that's grown to be one of Buffett's larger positions now. Like, it turned up in his annual letter this year for the first time, and he hasn't put an extra cent in it since 2012 or something roughly. So that's been a home run.
2009, yeah.
Oh, there you go.
Right at the bottom.
What about you, Tom? Who's your favorite investor?
Man, there's so many. It's hard to pick. I'm going to be the least obscure, I think, of all these favorite investor pitches, because I'm just going to go Monish Pabrai, which everyone watching probably expected me to say that, or Buffett. But I mean, he's been he's probably the one who has a strategy that most closely mirrors my own, I think, is probably why I'm saying that. So he's someone that I've found has just been able to distill what some people can make, because some people make investing out to be a really complicated topic, and Monish Pabrai sort of distills it down into some pretty basic ideas. And that's just something I've related to. Like, I've read the Dando Investor a couple of times now, reread it again this year, and it's a lot of the things that Pabrai said, even though he's had a bit of a change in investment philosophy this year, just make a huge amount of sense to me. So he's my favorite investor. I even grew a moustache in his honor last November, right? So it's hard for me to go past him.
That was an excellent Movember. You raised quite a bit of money for charity back then in November. That was pretty awesome. I think you had one video where you're like, I was walking down the street and someone approached me and asked, "Hey, are you Monish Pabrai?" I love that. That was so excellent. Great.
Yeah,
Monish Pabrai, that's a safe one.
Yeah, it's a safe one, but I think he's top of the list.
I don't think anyone's going to argue.
He's definitely one of, if not my favorite investor as well. I just tried to pick something outside the box, but Monish is someone I follow more closely than probably any other investor, I think.
Yeah.
So who's bidding on the lunch?
I think we're all teaming up, aren't we?
We have a fund, the lunch fund.
And you might have to pay for us with that Gamestop money.
Yeah, Karan's our leader. He's the fund manager.
I like how generous you think.
I thought this is why we've started this channel and trying to get to 1,000 subscribers to fund the Pabrai lunch.
This is all just a rehearsal for how we're going to ask questions to Monish Pabrai.
Everyone in the chat, let us know how we're doing in our prep for this lunch, and we need your help, like really fine tuning things. So smash the like button if you think we're doing a good job. And subscribe, share with your friends, send it to your mum. We need to up the views and get the ad revenue coming in for this next auction. Send it to Monish Pabrai because he's active on social media. Yes. So maybe because Tom, you got the retweet of Karan's mug.
Brad's had a few as well, I think.
Yeah. He's keeping an eye on us, I think.
He's generous with his retweets, which is
I think
great.
He's in the chat right now. Monish might be watching.
Yeah, this is for everyone who hasn't seen it on Karan's channel, but he sent us all these awesome mugs. It's like a sheep
with used it myself
with the Monish mustache, shameless cloners, fabulous design.
Thank you.
And then Monish retweeted that when Tom posted a picture of it, so he's seen it and approves, which is amazing. Life's over, we're good.
Jack, tell us about the Grave Dancer.
Yes, so I'm more of a real estate guy myself. So I was like trying to think of who like my idolized investor are, and like Tommy said, there's so many to choose from. But I'm going with Sam Zell, since we had our conversation a lot about cash and liquidity last time, and he's probably someone you can learn so much about the value of having cash available in a crisis, or even not in a crisis, just having the flexibility to go in and really do some otherwise fairly risky things to deals, because you can get them at such a good price when no one else has liquidity. So there is tremendous value to having cash, even in an inflationary environment. For example, he made a ton of money in the 70s during stagflation with real estate, since he was one of the few guys who had a ton of cash available to go in, buy these properties with fixed rate debt, and then ride the inflation wave to huge gains. Whereas other people who didn't have enough money at the time were out. So he's got a lot of great lessons beyond that, of course, but that's kind of the central theme that he often goes by. And Brad, like you were saying, the Grave Dancer is the nickname he's earned, since he often will sort of hang around distressed deals looking for ways to that he could restructure a deal or do something to make it better, since he really takes the value investing approach and applies it super heavily to real estate, in that he's trying to get things below cost, below their replacement cost, so the cost to actually build the building. That's his general approach to real estate investing, and it's paid off handsomely for him now. He does a fair bit of stock investing too. He's got a SPAC right now, for example. So that's my 2 cents on Sam Zell. Plus, he's a very entertaining speaker when he does speak, he's got a great book as well, Am I Being Too Subtle, which got on my desk right here. This one is a great one. Highly recommend.
Yeah, cool. Has Sam Zell ever invested or made big bets outside of real estate, or is just that's purely been his focus?
Yeah, that's his main niche. But let's see, he bought not the Tribune. He bought a huge newspaper a long time ago, Charlie Munger-esque, I suppose. And then turned that around. He bought a bunch of radio companies back in I think the 90s or the 2000s. He's trying to get a distribution tech firm right now with his SPAC. So a variety of holdings, but yeah, his bread and butter has been real estate mainly. He sort of pioneered the office REIT, which wasn't really a thing before he started doing it a few decades back, and had a ton of success with it.
Yeah. How does he always end up with so much cash at the right times? What's he doing? Is he just is he a hardcore market timer trying to sell?
Kind of. He has a hair trigger to sell, is what it kind of seems like, and it's worked out very well. His most famous deal was when he sold off Equity Office, which was this huge office portfolio. He sold it to BlackRock in 2007 or 2006, right before the crash, and made out like a bandit. And then he used that to go buy things like Equity Commonwealth, which is the company that I invested in, Karan's invested in as well, sitting on a ton of cash right now, waiting patiently for that deal. Basically, he doesn't, it's not so much market timing, but he'll look at the cost to actually build the property, for example. And if he gets an offer he can't refuse, he's going to take it. He's not hesitating to take a deal when it's when he can sell it and potentially wait for a better opportunity when there is a crash or when there's some distressed deal that he can take advantage of. So I wouldn't call him a market timer, but that's kind of how it's ended up working for him in when he happens to sell his deals. It's not like he was predicting the 2008 crash when he did that, but he said that he got an offer he couldn't refuse, which makes sense since things got so euphoric. He doesn't get caught up in the euphoria is probably the best answer.
What is Sam Zell's current position on the office space, that environment? Is he pretty firm on that, or is he branching out into other sectors? What's he doing?
He's not super stubborn, but yes, he is bullish on office long term, even downtown office, which has obviously been hit hard this year. Well, revenue wise, it's been fine, but a lot of offices, especially in the U.S., are still largely empty downtown, and he has major concerns that there's been a huge oversupply of office buildings in the last 20 to 30 years. So he has concerns there, and he's looking at other areas in real estate as well. The only one he's been really out against has been retail. He calls it a falling knife. So he's trying to stay away from that. But he is not net bearish on office. My guess is he's waiting for something to happen to the office market so he can get those below replacement cost deals, since he really does believe that working from home on a broad scale isn't super effective. He's very much into the social environment of working, because that's how he's run his companies. So he is pretty bullish on office, generally speaking, but he's not going to overpay for office. That's his general approach.
Great.
Well, there goes that merger idea you had, Karan.
Yeah.
Yeah.
I even sent them a letter. I was like, hey, you should totally consider this.
Yeah, Karan is like, hey, hello, I own 700 private islands in this part of the world. Can you please listen to my thoughts?
No, wouldn't it be perfect? Equity Commonwealth has cash. Seritage needs cash. They have property that is below replacement cost. I mean, it makes sense for them to merge. I think.
It definitely could work well. In case you guys missed that, Seritage Growth Properties is heavily indebted, has a lot of retail properties, but is trying to do a lot of retrofitting to change the properties, make them not retail or otherwise better, and turn around the portfolio. Meanwhile, Equity Commonwealth, Sam Zell's REIT, has tons of cash, like a couple properties, a couple office properties, but way more cash than anything else.
3.4 billion now.
Yeah. And it's just sitting there, and he's waiting patiently. And perhaps if those two companies merged, you'd have this great synergy, and you'd get this influx of cash that Seritage could use to pay down a bunch of debt that they have. And it's a thought, and I think it's not a bad idea by any means.
See, they are burning cash. They have a lot of cash. It works perfectly.
Yes. Add fuel to the fire.
Hey, Jack, I think Sam Zell is in Chicago. You got to go find him and knock on his door or something, man.
I can't. I thought I was going to come close. So I'm in this charity group in this. It's this big sort of real estate networking sort of charity group in Chicago called the Eisenberg Foundation, and he recently gave a talk, but it was pre-recorded. So I was like, I thought I was going to be able to like ask a question or something, but came close. Sometime soon. I know some of the people who were able to connect with them, so I'm closer than I think. I believe, but we'll see.
1 degree of separation.
Yeah, maybe more than one, but 2 or 3. But we'll see. Anyways, enough about Sam Zell.
We need to get him on the stream. If we had a 6th person, that would work really well with the video tiles we've got going on here.
Yeah, and if anyone has a plug with, or if anyone has an in with Sam Zell or Monish Pabrai, just let us know, and we'll get them on here. They can do whatever they want. And then, who hasn't gone?
I have
Brad, I think.
Brad, who's your favorite investor?
So I don't know that he's my favorite investor. I like that he kind of flies below the radar. He's only managing $9 million as of last month, and that's Andrew Rosenblum with Bonsai Partners. I just listened to an interview with Andrew Rosenblum today. I sent you a link, Jack. It was with Good Investing Talks. And it was phenomenal. So he goes a lot of different places in the interview, but he was asked, why Bonsai Partners? How does a bonsai tree represent what you're trying to do as an investment firm? And his answer was, well, it really takes years to kind of shape this bonsai into something beautiful, something magnificent. And so it's a nice analogy for investing, what it takes to really grow, an amazing portfolio of businesses over the long run. And he even said, bonsai trees, they usually don't reach their, zenith until after the master has passed away. And so there's this kind of beautiful analogy there. And I came across Andrew researching Micron technology. So Bonsai bought Micron, I think it was early 2019. And in the quarterly letter, which, Andrew puts out a letter each quarter that's available to the public, which is awesome. Here's one of the letters. He did like a 6 or 7 page write-up of Micron. I just thought this is really dialed in. I thought it was a very high quality write-up. So I've been reading his letters ever since. His biggest position is Redbubble, which Frank mentioned. And actually in that talk that Jack just shared, he goes pretty in depth into Redbubble. It's a pretty fascinating story. So the unfortunate thing is we can't see for sure what Andrew holds each quarter because he's not required to submit those 13F filings. So it's possible when he puts out these letters, he's not sharing everything, especially if he's still buying into a position. But I resonate with the way he thinks as an investor, and I'm excited to kind of grow alongside him and really pay attention to what he's doing each quarter. Frank, do you have anything to add? I know you've been digging into him as well.
And so I'm actually a shareholder of Redbubble as of the past week or so, and I originally came across it because of Andrew Rosenblum. So a friend of mine shared his returns with me just because he was one of these investors with ridiculous returns. Jack had it up just before. It's about 100% annualized or something ridiculous.
Over what, 2 or 3 years? So it's
over 3 years. So yeah, a short time period, and most of those returns actually came from Redbubble.
Right.
So I'm well and truly late to the party compared to when Andrew Rosenblum came across it. And it's an Australian company. He's in America or Canada, maybe. I think
he's in America. California, same place as I am. Yep.
But yeah, super interesting dude, fairly young. I don't know how old he is, but he looks and seems pretty young. And I think it's a good one to follow for the very long term because he's a super smart guy, really well spoken. His strategy aligns with me pretty well. Super nerdy type guy, like really, really almost autistically smart. So yeah, I really like him.
Yeah, it was interesting too. He shared that when he started out with a firm in Boston, he was the only guy responsible for finding shorts in that
that's
firm.
right.
And he mentioned, after a while, he started to see that when you're going short a company, each additional 10% you win, you're actually getting less and less. So it's like anti-compounding is what he described in that talk that I shared. So it was interesting to kind of see it that way.
And I never even would have thought of that, but I guess that makes sense.
Yep.
It's the law of big numbers reversed.
Right. So yeah, a guy to check out for any of you who haven't.
So now you've heard
What's his fund size?
9.2 million as of last month.
It's really that small.
Yep.
Wow.
Yeah, I looked it up on Advisor Info.
Those small funds can be a great source of inspiration because
Yep.
it's a lot of overlooked stuff often. So,
Mhm.
It's a one-man show. It's just him, he said. He's the only employee, so.
And that's like what Buffett and Munger always kind of like, or really all larger value investors tend to be like, oh yeah, if I was running a $1 million firm, I'd be able to double it in like a couple of years. And like, they always just kind of write it off. Like, yeah, I could handle a small fund, no problem. And then you see examples like this, you're like, oh, I guess there's some merit to that. It's just when it gets to that huge scale, like we were talking about earlier, it just becomes a lot harder to scale those really good investment ideas. And anyways, we're at about the halfway mark. So if you guys have questions, start queuing them up in the chat, and we can start answering some of your questions.
Well, I have a question related to what you just said, Jack. So
Mhm.
I'm curious to hear from you guys. Is there a certain threshold AUM that you look for when you're considering cloning investors? Over which you start to see diminishing returns because of size. Do you have an idea about where that threshold is?
I'll jump in quickly on that one. I look for the smaller the better. So I'm looking for like these, mostly people on Twitter that run small amounts of money. Some of them private investors, some of them small fund managers. But a lot of guys like, I don't know, Elliot Turner is another one that I like. Rosenbaum, like we mentioned. There's lots of guys on there, and I'm more interested in the companies they're talking about. They're usually not as recognized by the market, so more likely to find undervalued companies, in my opinion. That's just what I like.
Now, I want to follow that up with, are these dollar bills for 50 cents or 30 cents that they're looking for, or are they also these kind of long-term compounders? What are you seeing?
Well, Elliot Turner, the one I talked about, he's definitely a more long-term compounder.
Yeah.
Pays up for a lot of businesses from what I've seen. I don't think he would admit that he pays up, but the positions that I see he holds, they're certainly not deep value positions of any kind.
Right.
But yeah, there's other guys on there that have more deep value type portfolios, like someone like Michael Mitchell, other way around.
Mike Mitchell, yeah.
Two first names. He runs like a concentrated deep value approach, a lot of strange positions, but another one that I follow as well.
Yeah, Elliot Turner says he's a GARP investor, so there you go.
Yeah. Sounds about right.
I don't think I necessarily discriminate based on size, but I think to what Frank was saying is like it's more likely that you're probably going to find better ideas from smaller investors, or at least whether it be compounders or the 50-cent dollar bills. Often you're not going to see large, more institutional hedge funds or whatever investing in cigar butt type things, or some of those more niche value plays. So I don't say I'm not doing a blind cloning approach outside of the Magic Formula portfolio, of course, which is like a little experiment thing I'm doing on my channel. But like for my main portfolio, I'm pretty indiscriminatory.
So I think I run a little bit of a different strategy. So I think one of the best advantages retail investors have is to invest in illiquid positions, and these large fund managers can't buy illiquid positions. So that's why I like smaller guys, because I want to fund those type of companies. That suits me better anyway.
So, size is not important, but anyways, there's other things to life. All right.
I knew someone was going to sneak that in.
I didn't see it coming, but I should have. What a shame.
I was just going to say I don't really have any hard and fast rules on size. I think I agree with the general principle that if you can find people smaller, then you're more likely to find stuff that's kind of interesting and the wider investment community hasn't picked up yet. I guess the downside is they're probably smaller because they haven't got their spectacular track records of 20% a year for a very long time. So there's that element. And then I think, I mean, even with people like Buffett, you've got to say that most of the time when he's buying a new position, it's perhaps not as interesting as a position he might have been adding when he was, running his partnership in the 50s or something. But, if you see him take a big swing at Apple and put like $30 billion into it or whatever it was when he first, got into that position, that's pretty interesting. And the other thing with a place like Berkshire is one of the things that I've probably been guilty of not looking at, but I think I want to start doing a little bit more, is paying a bit more attention to the smaller positions, because you have, Ted and Todd, for example, running sort of roughly 10 billion or so kind of dollar portfolios within Berkshire. So sometimes you can sort of see smaller positions come up even within the larger fund. That said, it's hard to gauge conviction when they're like these little small positions, but I think it's kind of interesting to at least give some of those ideas the time of day.
And there's no way to know for sure if it's them who's buying, right?
Yeah. It's pretty obvious if it's Buffett sometimes, but hard for the small ones.
And another big thing with something like Berkshire is they're more akin to like a bank in that they can do some pretty tremendous deals that the average person could not do. Like when they bought all of I think what it was Dominion Energy's like that portion of their portfolio. Like you and I can't do that. We can't like siphon a part of a business off, but they can. So that's like a unique thing that the average investor couldn't really do. But a smaller fund's not going to do that either. So you're not going to have that sort of, I don't want to call it noise, but it's a different sort of approach when you get to that scale.
So real quick, Frank,
and we can't. Sorry, you go, Brad.
Frank, I just looked up Elliot Turner's fund, 107 million under management. So not small. It looks like they're just going to have to start filing their 13 Fs.
Oh, that's pretty cool. That'd be
It's
interesting
good
to
for
follow that. Because I only hear about positions he talks about on his podcast and
There
a
you
couple
go.
write-ups he does, so that'll be handy.
Yeah. Go ahead, Tom.
I've blanked on what I was going to say. Oh yeah, the other thing I was going to say is the other thing that Berkshire does, which we can't, is like issue debt at 0% interest rates in Japan and Europe and all this stuff, which is
it changes the
pretty
game.
Interesting. Yeah, I guess the thing we can do is buy Berkshire, but it's hard to get in on one of those specific parts of Berkshire that's really interesting.
Right. I own Berkshire as a decent portion of my portfolio. Kind of just I don't want to. It's kind of like I don't want to say defensive because it just has so much cash, but a lot of my positions I found that I've put a decent amount of money into have a lot of cash. So it's like, I don't want to call it a cash equivalent because it's definitely not, but it's like, I like having that sort of built-in liquidity, especially during this frothy time. So if there's some opportunity that arises, they can come in. It's like same thing with Berkshire, what they did with Bank of America back in the crisis. That was huge, which if they didn't have all that cash, they wouldn't have been able to do. Get their nice 10% preferred dividend or whatever, and a huge chunk of the business. Like that's something that they can leverage because of their size that a normal fund, a normal or smaller fund couldn't really do.
That was Goldman, right? Wasn't? Or am I wrong?
I'm pretty sure it was B of A, but I think he did something with Goldman as well. Am I mixing that up? Anyone correct me? Maybe, whatever.
No.
Okay.
I do know he did get sent an email by AIG. I'm pretty sure it was AIG that he didn't see till like a year later, asking for money in the midst of the financial crisis because he couldn't figure out how to use his cell phone or something. He asked them to fax it, and they never sent him a fax. They sent him some mobile message of some sort that he couldn't figure out. That's kind of hilarious.
Oh.
Yeah, he says he would have never done the deal anyway, but that's classic, like Granddad Buffett, isn't it?
Sandeep says it was definitely B of A.
All right, thank you, Sandeep. I got a little nervous there.
So I've got a question. Monish Pabrai talks about having 1 to 3 positions in his personal account. What do you guys make of that? Is that insane, or obviously he's done well with it, but I mean, he says a lot of the time there's just one position.
Mm.
What are your thoughts?
I wouldn't feel comfortable doing it personally,
Me
but
neither.
the best returns of all time are people that, like Monish talks about this, people that own the business. They invested in their just one business, like Amazon and Jeff Bezos. Well, Buffett's a bad example, but kind of with Berkshire Hathaway. All the biggest returns come from that one single concentrated position in your own business. So in that sense, that doesn't sound risky by just owning a large business, but when it's in a portfolio, it sounds like a scary thing to do. I wouldn't be comfortable with it, but that's not to say that it's not a good strategy if you're good at what you do.
To me, it's just defense versus offense. If you want to go extreme offense, then sure, like what Frank's saying is like you go all in on the business, whether it's your own or if you really have faith in it. Private equity might be an interesting example, but often they will diversify a bunch, like private equity, venture capital type deals where they'll have a portfolio of a bunch of different startups and hope that one takes off. So it seems it's extreme to do, the 1 to 3 position deal. A lot of studies show that the risk of the risk that's negated by diversifying often is achieved at something like 20 holdings, which if you get up to that, you're probably just about as good as a well diversified fund, as long as it's not all in the same exact sector or something like that. So it's like if you can get up to that point, you're probably getting all the benefits of diversification anyways. But maybe you still lose some of that offensive reach that having a super concentrated 1 to 2, 3 holding portfolio would have.
I recall Charlie Munger ran his own numbers on that back when he was, in law school.
Yeah, it's debatable for
he
sure.
He came up with 3 as
it might be.
So it'd be interesting to read the studies.
Yeah.
I think it's perfectly fine having just like 1 to 4 holdings.
It's fine. You just got to be ready for some serious volatility is all, which if you're investing for the long game anyways, you probably should be.
So I personally only
I
only have 5 positions. I don't I'm talking like 3's a bad idea, but I only have 5. So
right. It takes a while to get to
double.
those 20. That's the difference. It's like it might take 10 years to get to 20 positions if you're doing the punch card approach, where it's real slow, very selective. But eventually you get to those 20 punches or however many it is, whatever arbitrary number we decide to pick. And
I think it depends on what the positions are as well. Like Charlie Munger today still tells everyone he has 3 positions, but he doesn't really. Like he's got Berkshire, which owns like 90 subsidiaries plus the stock portfolio, and then he's got Lilu's fund, which I don't know how concentrated Lilu is, but let's say he's probably got at least another 5 positions in there.
Yeah.
And then he's got Costco, which is the one business, right? So
it's kind of cheating.
It depends what's in the 3. Yeah.
I found that funny when he's like, "Oh yeah, I'm super concentrated in Berkshire." Well, it's like, I mean, that's a bunch of businesses, but okay, but it still is relatively concentrated compared to like a broad index fund, which is incredibly diversified. We got a question here from SC358.
Even with respect to this, I think one of the mistakes that I'll have 10 years out is probably selling out of Gamestop, because if I was just in that one business and holding it, I think my portfolio would have done better. Like, as opposed to every other investment that I've got, even if that was not there and this was like 99% of my portfolio, I think I'd do okay. I know it's very controversial to say right now, but
go deeper, Kron.
I mean, it would still be like what, a 20x at current levels. And if I'm just holding it for the next 10 years, I mean...
So what you're saying is you don't see this spike as temporary at all? The pump?
I don't. I actually think the business does have a future, and I think it can do well. I think it can do really well. I think I'm going to regret selling out, even though I sold out. The price that I sold out at made sense. So I sold out at like 400-ish, 450.
Gosh.
Good move.
Because it was 100x at that point, right, Karan, for you?
Yeah, that's what. I saw it as 100x and I'm like, I'm out. I'll take the money. Thank you.
You need that gun that shoots the dollar bill.
I think in like 10 years, I'm going to be like, oh, that was a big mistake. Like I should not have sold out of it.
So you have a strong hunch that there's going to be a serious turnaround, is what you're really saying.
I bought back in at $50, so around a 3.7 billion valuation. And then I sold out again when it hit like 300.
You got it. The second bite
So-
at the apple.
Yeah, I was like, this is ridiculous. And that was again within like a month. So I should not have sold out. Like, I think that was a
You're
mistake.
doing all
I
right.
didn't have
though.
the diamond hands.
Yeah, no.
Diamond
But you put it into other positions that I would think are more undervalued, I'd imagine, than GameStop at that price. Or do you disagree?
Yeah, I mean, again, right now it makes sense, but I think years out, I'm going to be like, oh, I shouldn't have sold out of it and should have just. So yeah, being in one company is fine. Like, and especially if you got such a huge margin of safety. I mean, buying the company at 250, 300 million, today it's sitting at around 10 billion, you know. The
So
buy
at-
price was so good, yeah.
Right.
At what price for GameStop do you push the chips back in?
Sub 5 billion, like around 3-ish billion.
All right.
I don't think it's ever going to get back there.
Yeah.
I hope it does, but I don't think
Hot,
so.
hot takes from Karan.
There you go. we got our
That was
short
great.
Right there. We got our short.
Yeah, what I'm hearing is that GameStop is Crystal 2.0, and we're currently in 2005. Does that sound about right, Karan?
I mean, it's not a business that an idiot could run, right? You've got a very good chairman of the board.
You mean to do the
yeah.
turnaround? That,
Yeah, I mean, in June, I think he'll announce what exactly his plan is moving forward. But you see the people he's hiring right now. So he's gotten people from Amazon. He's gotten people from Chewy. The company's hired its first CTO. Like, these are not small changes, right? And especially, again, it was the buy price. The buy price was amazing. Like, it was a huge margin of safety. So, I don't know.
Yeah. Sorry,
Right
Jack,
now,
we
I'm
should-
very
we
happy
just-
with it. But years out, I'm not sure.
well, we've documented this, so you can
That's right.
come
There's
back
no
to this
hiding
video.
now. There's
and
no
then,
hiding.
yeah, it's public.
Yeah.
Everyone hold Quran to it. So let's actually get to some of these questions now. SC358 wants to know, Frank, if you could clarify some of your Redbubble decisions, since you just recently made it. And he's talking about the flywheel concept here. Could you talk about how you think it's competitive versus other competitors in the space? Since it does seem like it is a fairly low barrier to entry, Redbubble. Maybe you could explain the business a little bit more.
Yeah, so I'll break it down a little bit. So SC is actually my Discord. So we talk about this, we go back and forth about this on that Discord. So the Flywheel Effect is essentially the business has three parts. They have their customers, they have their artists, and they have a fulfillment and operations team. If you invest in any aspect of those three, the theory is that it's a flywheel effect. If one grows, the other two grow. That's the flywheel effect. But I think the competitive advantage is more so the fulfillment and operations side of the business. Most online marketplaces don't have fulfillment and operations teams. So as a artist, you don't have to actually do anything. You create the art and you put it on there. You don't have to make a product. So your margins are very different. Your amount of effort you have to put in is very different. There are other websites doing the same print-on-demand service. So the competitive advantage over those is their branding and their popularity at the moment, I guess. There's no other public company that does exactly what Redbubble does. And of the other online marketplaces, no one has that fulfillment and operations aspect of the business. So they suffer in their gross margins because of that. But that's the appeal to artists and convenience for users. And it adds to that flywheel effect, which is definitely part of their competitive advantage as well. And then the other aspect is, I'm sure Brad would have heard about it too in that interview with Andrew Rosenblum that we shared earlier. He talked about allowing the consumer, this approach is from, to be individual. They can choose what they have in their product. You don't have to go to the supermarket and hope there's something you like, or to the shopping malls or whatever to find a shirt or a painting or whatever it is that you like. You can customize it yourself. It's an interest-based service, I guess. So it's like the reason I like Twitter is it's interest-driven, which I think is a competitive advantage just in itself. But yeah, that's how I'm thinking about the competitive advantages. There's a lot of other things I like about the business as well. I bought in knowing that there was an announcement coming out, and the announcement turned out not to be great, and it dropped 23% on the day. So I doubled down on my position and averaged. So I'm down about 10% at the moment, roughly, on my position. But long term, I'm fairly comfortable with Redbubble. And of course, that's not financial advice. That's just what I'm doing. Don't listen to me.
And I really like the aspect where the artist, right? The artist typically gets, 20%? Redbubble gets 30, and then the fulfillment gets 50. But as the artist, you get to set the price. So if you want something to be more expensive, you get a bigger cut. So I think that's kind of a cool, thing for artists to also have more say over the business decisions.
Yeah, definitely. So the main comparison that people use for Redbubble is Etsy. But for that reason Brad just explained, I don't think they're fair to compare at all, because Etsy actually have to produce a product and sell it. These artists just create their art and set their margin to do whatever they want. So,
Karan,
yeah,
you got to make all kinds of products from this. I want my shower curtains to say "Shameless Cloners."
Karan could have put that on Redbubble, actually.
Teespring is a competitor, right,
Teespring.
for Redbubble? Yeah.
Yeah.
That Spreadshirt, I think, is another. Printify, all the Shopify plugin. There are a
Do
number.
you see the margins compressing for Redbubble because of all the competition?
Short term, that's what the announcement was about. Short term, they have said their EBITDA margin will go down. It's about 10%. It'll drop off to about 5 or mid-single digits is what they said. But they said by 2024 it should be closer to the 15% mark, or between 10 and 15. So
is that because of logistical concerns right now? Especially, is a lot of their manufacturing out of China or anything like that?
No, so the main reason they're doing that is they just got a huge spike of new users, obviously, with COVID and the shutdown. So a lot of people went to their service.
Gotcha.
So they're trying to reinvest into retaining those, like the retention of their customers.
I see.
And just the overall user understanding of their platform. But
almost an embarrassment of riches then.
So I don't know if it's a good thing. It's bad short term. Their earnings per share is going to drop off, and Australian shareholders and most shareholders around the world will react to that, and it's probably going to get worse before it gets better. But as a long-term investor, when I'm reading this, it's a CEO letter he put out, shareholder letter, and it doesn't seem concerning because all the long-term things he talks about seems great. But because we're in a short-term driven market, I guess it's going to look bad for a couple of years maybe.
Well, moving on to another one. Someone's asking us about A2M. What do you guys think? I know we got a couple of A2M, I'll say experts here. So what do you guys think?
Yeah, I can go first if you like. I'm assuming you're saying Frank's the other person.
You can fall on that knife, Tom. That one's tough.
Yeah, so this is the A2 Milk Company, like absolute market darling of New Zealand for the last decade, and up like, I don't know, 6,000% or something in the last 10 years. And it's down like 65% from the peak, maybe. These are ballpark numbers. So yeah, there's a lot of concerns about A2 having slower growth. They've got a few issues in what they refer to as their Daigo channel, which is basically like a reseller market. A lot of it's in Australia, so they have basically people go into stores in Australia and then resell that product to China, and they're sort of running these little businesses, kind of running that model. It's a hard one. Like Frank said, I think there's a lot of new competition coming in, so they're probably likely to lose some of the premium pricing that they have. But at the same time, the stock's down so much that it implies a much lower growth rate than what they've achieved in the past. They've been growing at, I don't know the exact numbers off the top of my head, but probably mid 20% per year compounded for a very, very long time. And I think by my maths, the price implies roughly like a 10% growth rate moving forward. So it's not a no-brainer, but I don't quite know which way I lean on this one.
It's compelling, but not incredible.
It's a 14 bagger over the last 6 years. It looks like.
Is that
even after the drawdown?
Sorry.
Is that after the drawdown?
Yes, that's including the drawdown.
What about the management? I mean, is it the same person who's been running it?
That's
No,
boy,
the
Frank can take
management's
that one.
another
That's the other concern. Yeah.
There's been some concerns around the management team. I don't follow it too closely. I've valued it, and it definitely seems cheap. The quality was great. It's just kind of determined if the quality's still there. But a lot of the management team left. There's a new management team that's in over the past maybe 6 months or so, maybe a bit longer time. I'm not sure.
1 month.
Yeah, there you go. Even newer than I thought. But the old management, they did great for the business, but then there was a lot of, they sold out of their shares. There was a big sell-off from their insiders. They kind of had inside information, I guess you could say. They got out, looked bad on them. The share price fell, kept falling.
Yeah, I mean, the short answer to this question is like, if the business returns to anywhere near close to the growth rates they achieved in the past, it'll be a home run. And if it doesn't, it'll flop. And I don't quite know what's going to happen. It's a really hard one to analyze the business here. So I actually have a very small position in A2 Milk. It's sort of like, I don't really ever make speculative investments, but this is probably the one example of that I've got in my portfolio. So I'll be following it closely, see how this one plays out.
You got to keep the gambling bug satisfied at least a little bit, right?
Have you tried the product? Have you had A2
Well,
milk?
I was going to ask Tom, is A2 milk your post deadlift drink of choice?
No, it's not. You can buy like liquid A2 milk. So for anyone that doesn't know, A2 it refers to like a protein that's in cow's milk. So most cows produce a combination of A1 and A2 proteins, and A2 producing cows produce only the A2 protein. So I've always been actually quite skeptical on the science behind the potential health benefits of A2 milk. There's more supporting evidence coming out for that over time, but that's sort of one of their main selling points, that it's a little bit easier on the stomach, and a lot of their product goes into things like infant formula, for example. So yeah, I'm not having a lot of infant formula after the gym, but
I actually do use the infant formula. It's the formula we use here at home, and we actually have been struggling to get it. So since they've had these distribution concerns, at least where I live, Woolworths, which is one of the biggest supermarkets here in Australia, or it's the biggest, they haven't had it on their shelves for the past few months. So from a branding perspective, it's probably going to hurt here in Australia at least. We've been going to like small little chemists just to be able to get the product just to remain consistent, but it's definitely going to hurt moving forward, because a lot of people would have just stopped using the product because they can't get it.
It's a good sign that you still want it.
Yeah, it is.
Sticky.
We're still getting it. We go out of our way, so they're doing something right.
How about this question? Thoughts on Chinese companies and the risk that their financial numbers could be manipulated with very little oversight, or perhaps too much oversight from auditors or party officials, since a lot of Chinese firms have the party, the regime there has not allowed Western auditors to audit firms in the way that you would in like the U.S. markets, for example, which is obviously a huge red flag. And there's been examples of huge fraud, like with Luckin Coffee, for example. That was a huge disaster fairly recently. So it raises some red flags. So what are your guys' thoughts on that? I'm fairly skeptical whenever I'm looking at any Chinese company because of that. Just hard to know what's true. I'm sure there's a lot of great gems, but guys like Charlie Munger are going into Alibaba, so like there's something there. What are your guys' thoughts?
Pass.
I can jump in if you want. I don't have too many thoughts. I like the idea of having some exposure to the Chinese market, and I have all the same concerns that you're talking about. But I don't know. I don't know if I think is it propaganda? Is that why we think it's so risky? Like obviously there's some truth to it, but do we think it's worse than it actually is?
Probably, but the hard part is just determining what is true and what isn't. It's like I'm sure there's a lot of truth, but what's that 10%, 5%, whatever it is that's not true that you happen to be investing in? And, you know, that's what's hard. And I don't know what needs to be done to actually like to solve that. At least from the U.S.-China relationships are dodgy at the moment. So, and I know there's been threats from our Congress, for example, to delist Chinese companies on a broad scale if they don't cooperate with U.S. auditor standards. I don't know if that's what needs to happen to renew that confidence. I don't know if it's propaganda per se, but there's definitely a lot of fear that might be unreasonable. So I don't know. It's hard to say.
Yeah, it was interesting to listen to Li Lu's last talk at Columbia. He was talking about how the shift from investing in the U.S. to investing with China, so much of the learning that needed to happen for him was that interface between the government in China and the investing scene in China. So it's so different from the U.S. And I think because it's so different, it's easy to just call fraud on it before really understanding the nuances of, what's involved in that interface. So that was intriguing to me, hearing him talk about that.
I think you can just buy Daily Journal, and you'll have like exposure to BYD and Alibaba. You're good.
And practically any emerging market fund will have huge exposure to China as well. So like if you want to maybe diversify that sort of risk, if you're afraid of fraud but still want exposure to China, then that could be a decent way. Not investment advice, of course, but just an idea.
Karan, did you do a valuation on DJO recently?
No, I haven't looked into it.
Okay. I think you did, Frank, or no?
I ran some numbers pretty quickly and I made a mistake on it, which Tom actually corrected me on. But they're cheap, I guess, but I look at the portfolio and I'm a bit like, I don't know if I want to own that. I like Barber, kinda, but overall, I don't know. I'm not too interested. And the main reason I am is Charlie Munger, and in all honesty, he's not going to be there much longer.
Yeah, I did a video on Daily Journal, a Daily Journal valuation late last year, I think it was. So people could go check that out if they want. The part of that valuation that would need updating though is the stock portfolio, because obviously that moves around quite a bit. There's a really good write-up if people are interested that was done by Matthew Peterson on Daily Journal. If you just Google like Matthew Peterson DJCO write-up or presentation or something like that, you should get the PDF. That was probably done 2 or 3 years ago, so the numbers will need a bit of updating, but the method of valuation still stands. So it's a pretty interesting business. They've got obviously the big stock portfolio, they've got the dying newspaper business, which will continue to die, and then they've got this courthouse software, which I don't know if you're maybe ever going to come across that in your new career, Jack, but if you do, let us know.
It'd probably be unlikely. Everything's very state to state, and I don't think they're doing anything in Illinois. But yeah, I will let you. I'm waiting for it.
If you come and be a lawyer in Australia, I think the Australian government's a pretty big customer of Daily Journal. So
fantastic! I'll let you know when I move everything and learn a whole new legal system.
There you go.
Let's wrap up with this question, guys. This cigar butt versus wonderful business. I guess pros, cons, one or the other, both. Like, what are your thoughts on focusing on a cigar butt style investment or a wonderful business? I guess we should explain what a cigar butt investment is first.
This is where Karan and I get into like a brawl, right?
Why don't you guys lead it off then?
You go.
You walked into that, Brad.
I sure did. What is a cigar butt? So the idea with a cigar butt, I think it's originally from Benjamin Graham, right? It's this idea that the business, it's on its last leg. There's one puff left where you're buying it for less than liquidation value, effectively. So you're getting it at a deep value to what the assets are worth, at least on the books. And then the what was the other one? The great business,
right?
Where you put your money in, and the business does the work of compounding your money year after year, because it's got this high rate of return, high return on invested capital. It's got a great moat. You don't need to touch it. You don't need to pull it out, find new dollar bills for 50 cents, any of that. So that's kind of how I see the differences. And I assume the question is, which one, right? Which approach are we more?
If there's a preference at all.
Yeah, if there's a preference.
I think that, if you're buying into a cigar butt and it becomes a wonderful business, That's the best investment.
Oh, yes.
Like first the margin of safety is in the price. No, first the margin of safety is in the price, then the margin of safety is in the quality of the business.
Right.
That's ideal. I mean, so you start off with cigar butts is what I'm trying to say. And then if you get lucky, great. Otherwise you still get the last puff, you know.
When I was looking
Imagine buying Berkshire in 1960.
yeah,
Cigar butt.
Yeah.
Exactly, yeah.
and
That didn't work out well for anyone who copied Buffett.
going for more like asset plays, I think it's just easier to understand. It's very difficult to pick what the great business is, but it's pretty easy to read a balance sheet as long as there's not a bunch of fraud on it. I'm not saying that all balance sheets are easy to read, but you can usually tell, like, is this company highly indebted? Is there a value here? Do they have a bunch of real estate that might not be being shown? Do they have a bunch of cash that outweighs all their debt? Like, those are pretty nice, easier things to understand, as opposed to figuring out, all right, what's the next Amazon or what's the next whatever. That's super difficult to do, at least reliably. You could do it, but I just think, kind of to Karan's point, the finding a cigar butt, it could still turn into a great business, but at least you have some price insulation or protection, ideally, if you get it at a really good price. I just think it's probably more palatable when you're just starting out. And maybe as you get used to looking at a bunch of different companies, you might be better at identifying what a great business really is. So it's a mixed bag for sure, but I guess it sort of depends on what stage you are in investing.
I think the way I think about it is, why not have both? Like, why do you have to limit yourself to one type or the other? So most of my business is probably made of, I guess you'd call it the wonderful type business, but I certainly want to incorporate some deeper value plays. And there's big investors that are successful with either strategy. You have Michael Burry, who runs a cigar butt-ish type strategy. And then you have someone like Chuck Akray, or almost anyone we mentioned that has the wonderful business strategy. I don't think you have to choose between either. Depending on your strategy, you can do either one, you can do both, and as long as you do it well, you can see great returns. They're both ways to outperform the market if you do it right.
Inherently, what you're doing is you're buying something below its intrinsic value, which is the heart of value investing. It's just, is it because you're getting like the asset value now, or is it because the assets are going to grow in the future? It's two sides of the same coin, really. You're trying to get something for cheaper than what it's intrinsically, fundamentally worth. So
I want to throw this out there too. So one of Pabrai's commandments, right? Thou shalt have singular focus.
Yeah, true.
I'm wondering if this goes against that at all, looking for cigar butts and the great businesses. Is it trying to do too much? Are you going to buy a cigar butt and forget, oh yeah, maybe I should be looking for the long-term compounder qualities in this? Or am I just saying when it hits intrinsic value, I'm out? I think it's probably tricky to juggle both at the same time.
I think in any event, go ahead, Frank.
Pabrai really kind of switched from one strategy to the other. I guess that's what he's transitioning from right now. So I guess he's sticking true to that, doing one or the other. But I don't think he would be opposed to buying a cigar butt still. I know he says he's making this transition to long-term compounder type positions, but I don't know. I think SRG is still kind of a cigar butt-like position. It's an asset play essentially, so he still holds that. I'm yet to see any of these real compounder positions. I guess there's a couple in there you could class as that. But yeah, I think either or other's fine. Maybe you should focus on one more than the other, if depending on the amount of time I guess you have to invest. But yeah.
I think that's a great way to wrap up, unless everyone has any final thoughts. Since we're over our hour that we try to aim for every single week. So if you guys tune in, and be sure to subscribe if you enjoyed this conversation, since we'll be having many more of them in the future. And join that Discord, like I mentioned earlier. It's in the description below. I also put it in the chat at some point, so check that out, and smash that like button, because that would help us too. And maybe one day, like we were saying, we could get one of these great investors on board to chat with us. That would be
Should we give a
magical.
shout out to the Shorts channel? Is that a separate channel, Jack? Or
If you guys want, we started a new channel that's linked to this one. It's called Punch Card Clips. So it'll just be shorter clips. If you guys maybe don't have time to watch the entire hour or whatever at that moment, or just want to see some of the highlights from the episodes, we do have punch card clips if you guys want to check that out as well. But otherwise, all the main content is going to be on this channel, so definitely stick around if you want to see the whole conversation here. But otherwise, guys, looking forward to next week when we do it again.
All right. See you guys.
Sounds good.
All right,
See ya.
thanks
Thank you.
everyone.
All right. Take care.